Sell in May and go away. That is the talk in the stock market today as people look forward to the summer after a monstrous rally in both the Nasdaq and the S&P 500. With what seems to be a rally that nobody expected following multiple rate hikes from the Federal Reserve, people are considering taking profits and trimming their positions going into the summer and then potentially coming back in September. And there's obviously good reason for that, because data over the past 20 years has shown us that it might make sense to sell your stocks in May as markets either underperform or stay flat for the next 3 months. But folks, if you do your research a little bit more in depth, that decision might be very poor, because there's a very big difference in what's going on today versus what has happened in typical bear markets over the past 20 years. We have not seen inflation like we have seen today. We have not seen the US 10-year Treasury yield skyrocket at the pace that it has today. And neither have we seen an inversion like we're seeing with 2 and 10-year spreads. This means that as we're in the midst of this fight between the Fed, inflation, and obviously the recession, this sell in May and go away tactic might not work, and the results will differ from small caps to mid caps and large caps. So in this video, I want to explain exactly why that is the case by diving into some extremely attractive research conducted over the past few months, because we have only just seen a massive divergence between the performance of small caps and large caps. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's explain this tactic behind selling in May and going away. You see, since 1928, the 6-month return between May and October has historically been the worst for that time compared to any other 6-month time throughout the year. On average, returns have varied anywhere from negative 25% to positive 5%, which indeed is the worst performance in a 6-month time frame on most years. But folks, as we've realized many times as investors, there is a massive nuance to that assumption. As you can see, on average, E-mini S&P 500 index futures have seasonally, yes, indeed seen poor returns between May and October. But that does not necessarily mean you will get no returns at all. As you can see, typically the start of the year and the end of the year tend to be very good and see the market outperform previous cycles. You can see returns anywhere from negative 0.5% all the way up to 4.5% in those specific quarters. But if you look at the very middle of this chart, you can see that in some cases between May to August, June to August, or even June to September, your returns are actually quite good. And this trend has developed particularly over the past 10 years. As you can see, looking at the returns between May and October, we have only seen 2 red returns in 2015 and 2022, with the average return being around 4.9%, and on average 80% of the years returning positive. And what's more interesting is that in the recent 10-year time frame, July has actually been one of the best performing months of the entire year. So if you do decide to sell in May or June, you would indeed be missing out on one of the best returning months historically of the year. And as a long-term investor, that is one of the worst mistakes you can make, because in some cases, if you miss the best few days out of a bear market, you will often be treated with much worse results over a longer time frame, because obviously earnings and results get compounded. In reality, what this kind of sell in May and go away strategy is for the swing traders and position traders who might want to buy stocks in May and then sell them 6 months later in October. If you're investing for the long term and have been investing since the start of the year like most investors do, then this is not the strategy for you, because accounting for the capital gains taxes and potential transaction fees, you will come out on the other side with more losses and poorer returns if you're trying to time the market in the short term. And by far, what's even more important is that this adage depends significantly on what kind of commodity or stocks you're trying to trade. If you're invested in an index like the S&P 500, then this strategy is absolutely not for your benefit. But it is amplified even more if, for example, right now you're investing in small cap stocks. Because as you can see, if you're invested in any stocks that have a market cap of under $2 to $3 billion, you are underperforming the S&P 500 by a significant margin so far in 2023. This is a truly interesting chart, and as somebody who invests mostly in growth stocks and startups, this is a pretty big deal. As you can see at the bottom right, just over the past few months since the start of February, the correlation to the SPX has fallen off a cliff to all-time lows never seen since the pandemic and 2004. And as you can see, the Russell 2000 index here in black has also hit near new 52-week lows, while the S&P 500 is inching to enter a new bull market. And a big reason for why this is happening is because we are about to go into a recession and have been doing so for the past 12 months. Look, there's no way we're going to know which quarters we're actually going to go into recession. But the Fed interest rate hikes have a consistent effect regardless on small cap stocks. And as you can see, their earnings have already started to collapse since the start of the year, down negative 12%. Meanwhile, large cap stocks are only down around 1/3%. This is the big reason why the IWM index has been underperforming so much, and small cap growth stocks and unprofitable tech startups have underperformed so much in 2023. And although there is merit for these sell-offs in some companies having poor liquidity positions and investors rushing out to price in the worst ahead of a recession, there's also an opportunity brewing in this kind of decline. As you can see, every single time the iShares Russell 2000 ETF has hit this kind of relativity level, it's always been an opportune time to invest. With the correlation with the S&P 500 increasing significantly out of the 2009 recession, 2011 crash, the 2016 pullback, and also the 2020 pandemic. Out of all these red arrows, which are uptrends in the market, the S&P 500 performed quite well, which means the Russell 2000 ETF is also going to perform quite well, and small cap stocks will indeed then recover. Now, don't get me wrong, folks, this is not a surefire signal for small caps to outperform over the next 24 months. Clearly, the banks are in trouble, and they tend to also make up a big proportion of the small cap index, with held-to-maturity securities at some of the largest unrealized losses for these banks in their history. This has happened partially because of the Fed, but also partially because of all the stimulus that came out in 2020 that resulted in these balance sheets expanding like crazy. And although many Americans see this time as an opportunity to get out of the market, potentially selling in May and going away, I personally see this as an opportunity, like I always do in the American economy. Whether it be small cap stocks, which inherently, yes, are more risky, or large cap ETFs, I am going to consistently stay invested in the market because that is the strategy that has worked for me in the long term. As usual, guys, make sure to do your own research before investing in any individual stock. I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.